Good afternoon, students. Today we begin one of the most important topics in the field of finance and investment analysis, evaluating the financial and economic efficiency of investment projects. Every company, government, and investor faces a fundamental question. Is this project worth in investing? In modern economies, resources are always limited. Capital, time, labor, and technology. Therefore, investment decision must be based on not intuition, but careful financial and economic analysis. A wrong investment decision can lead financial losses, even bankruptcy. A well-evaluated project can create value, generate stable incomes, cash flows, strengthen competitive advantages, and contributes to long-term economic growth. During this lecture, we will examine the key methods and the metrics of investment appraisal process and which are worldwide used to access investment efficiency. We will analyze net present value, NPV, the gold standard of investment appraisal, internal rate of return, ERR, the project's expected profitability index, the value created per unit of investment, payback period, how quickly investment capital is recovered, and the debt service coverage ratio, DSCR, the project's ability to meet debt obligations. We will not only discuss formulas in this lection, but also focus on interpretation and decision criteria, and also real-world applications, especially in emergency economies, where the internal inflation and financial risks are significant. By the end of this lecture, you should be able to understand the difference between financial and economic efficiency, calculate the main investment indicators, and interpret results correctly. Make informed investment decision and uncertainty. Let us begin by understanding why time value of money is the foundation of all investment analysis. This slide breaks down how big projects like building a factory, a bridge, or hospital, or new software system are evaluated to see if they are worth to invest. Think of it as a roadmap for making smart decisions with money. So, this diagram shows that the process happens in 3 phases. Before you invest, planning, project, during the analysis, crunching the numbers, and when you finally make a decision. Here are the 5 steps of explaining simply. Step 1, identify the project pre-investment price. This is very beginning. You simply come up with an idea for a project. For example, a company might think we should build a new warehouse, or government decide to build a hospital, etc. Step 2, forecast cash flows, analyzing process. Now you try to predict the financial future of the project. You estimate all the money that will go out, costs of construction, materials, labor, and all the money that will come in. Revenue from sales, maybe money saved by efficiency, being more efficient. You do this for each of the project life. So step 3, select discount rate. Analyzing phase. This step is about the value of time. Money today is worth more than money in the future. It's the same amount of money in the future, because you could invest today's money and earn a return. The discount rate is a tool used to calculate the present value of future money. It's like the interest rate. You are to reverse calculate what future money is worth right now. For a company, this rate is step 4. This step, where you use numbers from step 2 and step 3 in spatial formulas to get a score of your project. The slide mentions two main types of company score depending: financial perspective and economic perspective. For a company, you use metrics as NPV, net present value, internal rate of return, profitability index, and DSCR, discount rate, and weighted average cost of capital. So, for a society, economic perspective, social perspective, you use different calculations to see if the project is good for everyone, even if it doesn't directly make a profit. Step 5, decision and the review, decision phase. This is the final step. You look at the scores from step 4 and make a choice. Invest in the project, a go decision, or don't, no go position. After the project is built and running, you also review step. You also review in later to see if your project's predictions were correct and if the project's performing as expected. This slide shows indicators payback period and the discounted payback period. Simple payback period. Initial investment divides annual cash flow. This is time to recover the initial investment from undiscounted cash flows. Pros of these indicators is it is simple, intuitive, good for liquidity focus. But there are cons. Ignores time value and cash flows beyond payback. The second indicator is discount payback period, DPP. Uses discount as cash flows to calculate recovery time. Time to recover investment using present value of cash flows. DPP is more realistic than payback period, but still ignores cash flows after the payback point. So, our project turns positive in 3 years from indicator payback period, but exactly it turns positive in 5 years according to discount payback period, because discount payback period is more realistic than payback, simple payback period. There are 2 ways of looking at a project. The bottom of the slide explains that you can look at the same project from 2 viewpoints, different viewpoints. Financial perspective, private, means that a private company or investor's goals is to make money. So companies care about returns to the people who provided the money, shareholders, banks. They use metrics like NPV, ERR, PI, internal rate of return. They use a discount rate based on their cost of money, weighted average cost of capital. What they care about is returns to the people who provided the money. Economic perspective, maybe the government or public agency, their goal is to improve the well-being of society. What they care about is the bigger picture. This includes things that don't have direct price tag. like externalities, the impact on others. For example, new train line reducing traffic and air pollution. Employment, creating new jobs for people, social benefit, improving people's quality of life. Then discuss risk analysis and sensitivity. There are 6 methods of analyzing financial risks. So, first one is sensitivity analysis. Varies one input at a time. For example, price, volume, cost, to see how net present value changes. Identifies critical variables, the project's key value drivers. So the second one is scenario analysis. Evaluates projects under 3 scenarios, best case, base case, worst case. Gives range of possible NPV outcomes with assigned probabilities. The third one is Monte Carlo simulation. Runs thousands of simulations with random input based on probability distributions. Output a probability distribution of net present value outcomes. The fourth is decision tree analysis. Maps sequential decisions and uncertain outcomes in tree form. Calculates expected monetary value at each node to guide optimal choices. Break-even analysis finds the minimum sales volume, divides revenue needs for the project to achieve NPV is 0. Critical threshold for go and no-go decisions. The last is risk-adjusted discounted rate. Adds a risk premium to weight average cost of capital based on project risk profile. Higher risk, higher discount rate, lower NPV. Simple but subjective. In this slide, you can see the core formula of present value. We can understand the indicators of discount rate, the minimum acceptable rate of return, typically weighted average cost of capital. Example, if weighted average cost of capital is 12%, a project must return above 12% to create value. Present value, the current worth of future cash flows after discounting, accounts for the principles that $1 today is worth than $1 tomorrow due to earning potential. Future value, what the sum invested today will be worth in a year at a rate of R. For example, 1,010% for 5 years worth $1,610.51 in the future.